how much insurance is enough? Should we get a whole life plan or a term plan? Today, I'm going to share with you my view on life insurance and also show you my 3.6 million life insurance coverage, the reason and rationale why I bought them. First, we need to understand why we need insurance. Insurance to me is a risk management tool that helps to transfer me and my family financial risks away. What are the risks? I would say there are three major risks that insurance can help to transfer the financial risk away. First is die too soon. Let me use myself as an example. My son is only 3 years old and my daughter is 7 months old. If I were to be gone suddenly, my wife may have a tough time in coping to bring up the two children. The best I can do is to remove her financial worries, and life insurance is a very good tool to take care of that. The second risk is live too long. Longevity is a risk if you have no money and no health. Thus, proper financial and retirement planning is required to take care of the money side. Maintain a healthy lifestyle is to take care of the health side, and insurance will act as a safety net to take care of the medical bills. The third risk is severe disability and critical illnesses. This can be tough to you and your family as you can't die but lost your ability to earn an income. Life insurance will come in to take care of the family expenses, and medical insurance will able to help to take care of the medical bills. Today, I will only talk about life insurance, which is to take care of the first risk and a part of the third risk. So when come to death coverage, which I call it capital needs, first we need to ask ourselves, do we need to leave behind any money if we were to be gone? If the answer is no, then we don't need any life insurance on death at all. If the answer is yes, then the next question will be how much and how do we compute it? First, we need to look at what are our needs. I use myself as an example. One is called dependent needs. I would like to ensure that the financial and education needs of my children will be taken care of until they are independent, like after graduating from university and start their career or business. Next is housing loan. I currently have a housing loan. I want my wife to have no worries on the monthly loan repayment if I were to pass on. In other words, I will prefer the loan to be settled when I'm gone. I will also want my wife to just focus on bringing up the two children and have no worries about family expenses and her retirement. These are all my needs. And let's say it work out to be 3 million. Do I need to go and buy a 3 million insurance plan? The answer is no. Why? We need to take a look at what we currently have. For example, we may have money in the bank account, money in CPF, and also existing insurance coverage. Let's say all this add up to be 1 million. Then we need to minus off from the 3 million, which will give us 2 million. Thus, my shortfall will be 2 million, and I will need to get a coverage of 2 million to cover my shortfall and fulfill my needs. The next question will be, what type of life insurance plan I should get? A whole life plan or a term plans? For whole life plan, it means for permanent coverage. It's to prepare for unforeseen circumstances or unplanned financial situation that may happen in any life stages, especially at old age. For term plans, it is more for temporary coverage that have a predefined end date. For example, my housing loan may end in 15 years' time. My children may be independent in 25 years' time. Thus, based on the needs for death coverage, usually a term plan will be a good fit and more cost-effective. Next will be critical illnesses. First, there are some misunderstanding on critical illnesses. Quite a number of people I've talked to told me that medical insurance, in short, the integrated shield plan, is sufficient to cover for that. Medical insurance is very important. In fact, it should be the first insurance plan everyone should have, as it takes care of hospital bills. However, this plan only pays for our medical bills. It doesn't cover our financial obligation or family expenses. Our family will still need to eat when we suffer from critical illnesses and cannot work. The bank will still ask us to pay our monthly mortgage loan installment when we are lying on our bed. Thus, critical illnesses insurance is to cover for all these. We may also need money for alternative treatment like PCM, or our family members may need to get a caregiver for us. I have seen parents quit their job to take care of their critically ill children, or grow-up children quit their job to take care of their elderly ill parents. When this thing happens, the income for the family will stop also. Similarly, we need to work out how much we need and then less of how much we have, like savings and existing insurance coverage. The difference will be the amount we need. The next question is, what type of insurance plan I should get? A whole life plan or a term plan? For critical illnesses, I'll usually suggest to get a combination of whole life plan and term plan. There are also many multiplier plan in the market, which is a whole life plan come with a built-in term plan inside, which we call it the multiplier. And this multiplier will end from age 65 to 86, depending on which insurance company you get the plan from. The rule of thumb for insurance coverage, I will usually suggest is a lump sum plus 5-year expenses. And the lump sum can be in the range of 100,000 to 200,000, depend on your lifestyle and your ability. What is the lump sum for? The lump sum is to cover out-of-pocket expenses that cannot be covered by the medical insurance, such as alternative treatment like PCM. It also covers for the additional living expenses like we need a caregiver, or we may need to take taxi or Grab instead of bus or MRT. Thus, it should be a whole life plan, as we don't know when we will have critical illnesses, or we may never strike with critical illnesses. Thus, we can't have a predefined date, and we want a permanent coverage to have a peace of mind, which is lifetime coverage. However, there may people tell that, oh, the return from the cash value for this whole life plan may be lower than investment if you were to do your own investment. However, do take note that for getting this plan, our focus is not on the return or the cash value. Our objective is to have permanent coverage, and we don't have an intention to surrender a plan, and we just want to have a peace of mind. Furthermore, the payout of this type of plan will increase over time as insurance company will declare bonus yearly, and this will form part of inflation hedge on the lump sum required, whereas a term plan is usually not inflation hedge as the payout is mostly level. Next, why 5-year expenses? When a person strikes with critical illnesses, it is usually end stage. Thus, if you are still around after 5 years, there's a possibility that you may have recovered and able to go back to work. If not, most likely, we should have already passed on. For this, a term plan is more preferred as the coverage should cease when we retire. As during our working time, we need the plan to cover for expenses or loss of income. But when we retire, there's no active income to cover, and we are drawing our living expenses from the retirement fund. Thus, if we are ill, the retirement fund will still be there for us to withdraw. Alternatively, you can also consider getting a whole life plan and a term plan combined, which is a whole life plan with multiplier. The multiplier will cease at a certain age between 65 to 86. By then, we should really retire. You may have noticed that when I compute the half part, I talk about savings, CPF balance, and existing insurance coverage. Then what about the money in investment? The stock and shares we currently holding. Usually, I will not compute that, as we will not know what is the value of our investment at the point of death or when we strike critical illnesses. I may have a 1 million portfolio now, but when I pass on that day, what happens if it is a bear market? My portfolio value may down by easily 20% or even more than 50% when the stock market crash. So should my loved one sold off the investment at the point of time to pay for the liability and living expenses? Thus, I will leave the investment portion out and take it as a bonus to my family members, and they will not be under stress or pressure to liquidate the investment during unfavorable market conditions. However, if you still want to take the investment portfolio into consideration, I may suggest you take a 50% haircut on the current market value to prepare for the worst case scenario. Now let's look at my life insurance. Currently, I have 2 whole life plans and 3 term plans, plus the dependent protection scheme, which is using CPF OA. My total death and TPD coverage is 3.68 million, and my critical illnesses coverage is 390,000 without adding in the bonuses from the 2 whole life plans. I have actually cancelled my very first whole life plan that I bought in my uni days. The plan only have death benefits and it doesn't meet my needs anymore. I have also cancelled an ILP plan, which I bought before joining this financial services industry. After knowing the pros and cons of the ILP plan, I decided to cut loss on the plans. For my current AIA plan, I've removed those riders that I think are no longer relevant to me or not cost effective. Although I need to pay the premium for this AIA plan till age 99, I feel that it is okay as the premium is not high and it will drop further after age 65 when one of the critical illnesses rider expires. The 3 term plan was bought progressively. One thing to take note that the term plan is getting more and more competitive over the years. The term plan that was bought a few years ago may cost more than the current term plan in the market despite we getting older. Thus, I have seen people replacing the term plan along the way. However, do take note that you need to watch out the risk like change of your current health condition when doing such replacement. One of my term plans comes with critical illnesses to cover the family expenses part, as my whole life plan do not have any multiplier at the point of purchase. The first term plan that I bought is with the intention to cover my mortgage liability. Then I add another one when my son is born. I bought a third one when my daughter is born. So this explains why I have 3 term plans. And you may wonder why it's from 3 different insurance companies. As I mentioned, term plan is very competitive. So every time when I want to buy a term plan, I will check at the point of time which insurance company is offering the most competitive plans. And that I will just get from the insurance company. You may have also noticed that I do not have any early critical illnesses coverage. Is early critical illnesses coverage necessary? I personally feel that it is a good to have plan. In fact, both my children and my wife have early critical illnesses coverage in their whole life plans, as I feel that it is cost effective to them. If you want to know more about what insurance I get for my son, you can check out my previous video on his insurance. Now back to my own coverage. When I bought my 2 whole life plan in the past, there was no early critical illnesses rider offered by the insurers. It was only at a later stage where more and more insurers start to offer early CI plans, and subsequently the premium become more and more competitive. So everyone is different when it comes to insurance coverage. For me, if I die with early critical illnesses, I should still have income, although it may be lesser. Then I weigh on the cost benefit aspect due to my age and also look at my asset and income. I feel that it may not be as cost effective for me. This is why I didn't get an early CI plan. How much should we pay for our insurance premium? I broadly classify insurance into 6 categories: death, illnesses, hospitalizations, disability income, long-term care, and personal accident. The total premium should not cost more than 10% of your gross income. The lower the better if you can achieve your needs. However, you are paying the premium for your whole family, like your children, your spouse, and your parent, then it should not cost more than 15% of your gross income. Based on my 18 over years of experience, all these are achievable most of the time as plans become more and more competitive, and you just need to look out for plans that are cost effective and able to meet your needs. That's all I have to share with you today, and if you find that this video benefit you, do remember to like, share, and leave your comment below to let me know what you think. Lastly, do remember to subscribe and press the notification button so that you will be notified on my next video. I shall see you in my next video. Bye bye.